welcome to NDTV Profit. You're watching Earnings Edge, and with me today is the Wipro management, Srini Pallia, who is the CEO of the company, Aparna Iyer, who is the CFO, and Saurabh Govil, who is the CHRO of the company. Gentlemen, Aparna, thank you very much for joining us on NDTV Profit. To begin with, Srini, you came out with a guidance which seems to be a little muted, plus 1% to minus 1% for Q4. Can you take us through what all you have penciled in for the Q4 guidance?
First and foremost, when we give a guidance of -1 to plus 1%, it's based upon what we see as of today in terms of this quarter. Having said that, if you look at our Q3 performance, we had certain industries that have done well, specifically healthcare. We have seen BFSI, and we see the demand environment continues to be strong. Also, our pipeline at this point in time is strong across all the 4 markets that we have. However, the guidance is clearly based on the visibility as of today.
Srini, your commentary is strong. You're talking about good demand, but what I'm failing to understand is that despite that, Q4 is a very flat quarter for you at best, plus 1% on a quarter-to-quarter growth. What's preventing you from going for an aggressive guidance, or what is the on-ground situation like, which is preventing Wipro from putting out a good show here?
If you look at our 4 strategic market units, Americas 1 and Americas 2, the demand environment continues to be strong. However, if you look at Europe and APMEA, specifically in Q3, it was quite soft. So we take in the inputs both in terms of how we are heading toward, in Europe and APMEA, along with Americas 1 and Americas 2. So the overall guidance is based upon how we see these 4 markets.
Aparna, come in here on the operating margin, 17.5%, I think 12-quarter high for you in that sense. How do you see operating margins in Q4? And when you say that it will remain in a narrow range, can you quantify what is the range that you're looking at?
So, we don't guide for margins specifically. So it's very difficult for me to give you a number in terms of the range. But we've said narrow band, and you can draw your inferences. We are very happy to be at 17.5%. This earlier stated aspirational target band was 17 to 17.5%. We are at the top end of that band. It's been delivered on the back of continuous improvements through improved execution rigor in both the core IT services and our consulting businesses. So we feel very confident about holding our margins in a narrow band.
Given the fact that Q3 is seasonally weak and you had a wage hike also in Q3, you've been able to deliver 17.5%. In Q4 is traditionally a good quarter for most IT companies. Is it possible to sustain this high margins and even surpass it?
It's certainly possible that we sustain and improve. If the revenue environment remains supportive and we have a strong in-quarter execution, that certainly is a possibility.
Saurabh, come in here on your hiring strategy. 2,500 to 3,000 per quarter, means 10 to 12,000 is what you are looking at. But comment on the utilization levels, because you were at 84% in Q3 of last year and 83.5% this year. And this is on a reduced employee count. Where is this utilization? Why is our utilization level low?
It's a very seasonal thing. This is a quarter where there are furloughs. Because of that, every Q3 you will see utilization dipping. But the core business utilization continues to be in the right levels, and you will see an uptick back to the normal levels in Q4. So that's more a seasonal thing for Q3.
Srini, you've briefly touched upon the fact that BFSI in Americas 1 has done well. What is the situation as far as discretionary spends are concerned? Are you seeing that coming back? And also, is there any particular pain area that still remains in some of the verticals?
So if you look at month of January, is typically many of our clients are finalizing their budgets. Having said that, we see discretionary spend coming back, but slowly. One of the reflections that we have in the context of BFSI segment that you're talking about is Capco business. And if you look at Capco, especially in the Q3, we had a year-on-year growth both on the bookings as well as the revenues. And if you look at other sectors outside of BFSI, we see some of it picking in healthcare, but it's too early for us to comment discretionary spend in other industries. Having said that, if you look at the current pipeline that we have, the conversations that we have, cost optimization and operational efficiencies continue to be other big conversations that we're having with the client. Last but not the least, there will be uptick in the spend in the context of GenAI across the operations and infrastructure and applications. That could be another opportunity for us, which will also drive how the data and how the enterprises are ready with the data, the whole aspects of AI, data, and cloud, which will also drive core modernization for our clients. So these are all the factors that will also have an impact as we move forward.
Can you also comment on the TCV, because $3.5 billion in Q3, it's lower on a year-to-year basis, but what is striking here is the large deal component, $960 million versus $1.4 billion. What's the scenario there on large deals? Are some of the deals getting pushed, or the deal sizes are coming down?
So first and foremost, we do have a good pipeline of large deals this particular quarter and going forward. Second, if you look at our first half of the year, Q1 and Q2, we did have a good momentum on the large deal pipeline. As far as Q3 is concerned, I think it's $1 billion that we talked about, 17 deals coming in. But I would say that it's more of this quarter effect, but I would continue to see the momentum going forward in large deals.